Hey guys, it's Scott back here on Pink TV. Thank you for joining me here. I did a video recently about a property we had just flipped on a street called Wakefield, and I shared there some really important nuggets as to a real big epiphany we had that shifted our entire real estate investing strategy. And I just want to take a minute and explain that specific to this video, because if you're out there flipping right now, which is a lot of what we do and a lot of what I've done in my 26 years real estate investing, you have a lot of uncertainty in front of you. And a lot of it, if not all of it, is external factors that you cannot control. Many are intangible, i.e. interest rates rising. Here we sit in September of 22. The Fed has just raised rates this week, 3/4 of a point, have already said they're going to raise them again before the year is over. What happens when interest rates rise, it makes people's mortgage payments increase to the point where they get priced out of properties that they could have afforded had rates been a little lower. Certainly 12 months ago would have afforded them or could have afforded them, but now as rates go up, the values of the properties are out of their reach. They're unattainable. So until sellers will come back to reality or get it into their minds that there's going to be a slowdown of buyers that can afford that price of home based on the monthly payment, prices are going to end up going down at that point once they can get that through their heads. So all of this begs the question, if you're out there flipping, how do you protect yourself from these variables? How do you protect yourself from getting caught mid-rehab, midstream, mid-flip without getting caught holding the bag and ultimately losing money or having a really, really bad deal that ultimately you can get hurt on? It's a question that I've asked myself a lot subsequent to 2008. 2008, we lost everything. I tell people often that we thought we were smarter than the average bear, and we thought values were always going to go up. Historically, they have. They still historically are going to be worth more down the road than they are today. It's not always linear. There's ups and downs, but ultimately, we thought we were conservative with our loan-to-value ratios on the investment capital we were borrowing, but we lost everything. And I vowed at that time two things. One, never to be in a vulnerable position again to where we would be subject to all these external factors that could literally put us out of business and destroy everything we had worked for. Two, I was going to be in a position next market cycle, which by the way, for those that don't know, about on average every 10 years there's a market cycle, which means there's a correction or shift in values. Some are greater than others. 2008 was the most drastic shift in values since the Great Depression in the late 20s, early 30s, and ultimately 2008 was second to that. But every 10 years, 12 years, there's this kind of correction, and we're certainly overdue from 2008 being 2022 right here, about 14 years. I promised myself I would be in a position where I was going to take advantage of the downturn, and that's exactly what I'm doing. Having said that, we can make good buys, but if our whole business model is to flip the property and rates rise and the inflation is the worst in 40 years and the Fed's going to raise rates more and buyers are saying we're just going to cool down and sit on the sidelines, and sellers are saying but our values are still here, and they don't get it through their heads, and all of a sudden values come down and God forbid something crazy happens like another 9/11 or any unforeseen, if your whole model is to flip the property, you are in a real bad spot. So I had an epiphany earlier this year, and that I have kind of fondly named Blackstone Gold. Now, I've not shared this with anybody. In fact, this is all internal at this point. This is something we will begin training with all of our affiliates and the new folks that we're working with, but it's a strategy that is designed to weather the storm, to not let these external factors, these external issues like rates and everything I just mentioned, take your business down. It's designed to weather the storm. Let me just tell you briefly what it is, and it's been an entire shift of our business model. I couldn't be more excited about it. We're going to not only maximize the amount of profit we make on every deal, but it almost doesn't matter what happens with the rates, with the economy, with inflation. It always matters. I don't want that to be taken the wrong way, but it shouldn't affect how we sell and ultimately how we profit on these homes. So I can tell you one thing. I flipped a lot of homes. In fact, I've done over 3,000 deals. About 2,000 of those are flips. The more I get further along in my career, the more I feel like flipping is just a foolish business, because you're going and finding this asset, you're finding the buy, you're securing the deal, you're securing the funding, you're renovating it, you go resell it, you may make a great chunk of money, a nice hit, but you're going to pay a maximum tax gain. You're going to be in the short-term capital gain bracket, and you're also going to now go have to do it all over again. You found a great property, you rehabbed it great, and yeah, you've got a great equity position, but you sell it. Now what do you have? I mean, you got to go start all over. And it's been such a great business for such a long time, and I've done so many of them. I'm realizing had I worked a little bit of a different strategy, you know, I would have so many more rental properties than I do today. And whether they're rental or some variation of a rent to own, when you're flipping, you don't have any variation because you're done. You've lost that asset. So flippers, hope you're taking note. But Blackstone Gold means this. This is the strategy, and I hope that you can get something from it, and I hope that you can find a way to implement it. I think you'd be really, really glad if you did. Blackstone is named after a hedge fund out of New York City. Many people in the real estate space have heard of Blackstone because in post-2008, Blackstone had a hedge fund that was designed to buy single-family homes. So Blackstone are the smartest guys in the room, a lot smarter than me. These are the quants, the PhDs, the guys and gals that analyze data from businesses to determine what asset classes are going to generate the biggest return, the biggest yield. They identified single-family homes as an asset class that is a brick and mortar hard asset, can generate not only cash on cash yield or dividend or return on a monthly basis, but it's an asset that appreciates over time, and there's just nothing like it. Most stocks don't pay dividends, and those that do, you typically reinvest, you get a check every month. So the smartest guys in the room said, this is a great asset class, and I think they own 50, 60,000 homes. They might own more than that. I know they're the biggest landlord in the country. They bought all these properties in 09, 10, 11, 10, 11, 12, 12, 13, 14, doesn't matter. Down in Jacksonville, they bought like 3,000 or 4,000, crazy numbers. They're called Invitation Homes, where we are. I think that's what they've kind of labeled the fund. Here we are, arguably 12 years, 14 years later. These properties they bought are worth twice as much. They've made cash flow along the way. It's been an absolute slam dunk, out of this world, grand slam for Blackstone and all of their investors in identifying single-family homes as the asset class. Now, they still own many of them, still buying. BlackRock, another big hedge fund, just put together a $50 billion hedge fund or fund to buy, guess what, single-family homes. Doesn't mean you shouldn't be buying them too. There's deals in every market. I'd argue you have a better chance of finding deals locally than a big company like BlackRock or Blackstone would find, you know, just kind of being national and having individual representatives that are really agents that are helping them find deals. So don't let that spook you, but they're going to spend a lot of money because they've identified that asset class as well. Well, I have a mentor, a guy that I've learned a lot from in my time. I won't share names, but he has a strategy he calls his golden goose, and that's the gold part or golden part of the Blackstone Gold strategy and the name that I've called it. His golden goose investment strategy is this. You buy a house that's an investment property. It needs some work. You don't have to do all the work because you're going to sell it on what's called a work for equity, or you're going to sell it on a lease option. Somebody comes in, they give you a down payment. We like it when they're big down payments, typically 10%, but you can flex on that depending if the house needs a lot of work. But you put them in a lease option, you don't work real hard to qualify them to go get a bank loan, as long as they can afford the payment. Oh, you're going to do some due diligence. Don't take that out of context. You're checking credit application and your rental history, and we're going to take them through a third party, see if they have a snowball's chance and you know what to get qualified. But we're not so concerned about them getting a loan today because ultimately we're going to put them in the property. They give us a deposit for the benefit of having the option to buy the property. So they're paying us money up front to have the opportunity to buy the property at some point in the next 5 years. And in doing so, they take all of the repair responsibility, which means they are responsible for the home. There's no maintenance, upkeep, repair, improvements, leaky faucets, toilets. They're responsible for it. So as I've met with my mentor many, many times over the years, he would always say, boy, those guys at Blackstone, I know they're smart and they're buying the heck out of these properties, but they're spending so much money on being landlords and property managers and repairs and repair allocations and vacancy allocations, when if you had somebody in there that gave you an option deposit, they're going to take care of the property. You eliminate all of that crap from your life, and at some point, most cases or many cases, they are going to have a life change and they move and you go do it again. Now, some are going to cash out and you make a bunch of money, you go do it again, but the whole intent is to have somebody else in there making payments to you that you're cash flowing on, giving you a decent deposit, and taking care of the property. When you combine the two, Blackstone and gold or golden goose, you have the strategy, which is you buy them for cash. You have to coordinate or line up your money up front to be able to sell it on a 5-year or 10-year term. You can always get a loan to buy it and refinance that loan with a 30-year amortized loan, and that's another video, but that does make a lot of sense in the strategy. You get a private loan up front, you buy it, secure it, stabilize it, get it fixed up, and then you go sell it on a lease option, and then you would go get a longer term loan. But you're buying them and then you're selling them on terms. You can do less rehab to the property. You don't have to make it the Taj Mahal because you're not having to flip it and deal with all the other competing homes that are pristine and modern and updated. You can give it to someone that you're going to give them a little better price on the property. They get to do the work. They're going to get a better deal. And by the way, 8 out of 10 people, 80% of our buyers that have a choice to get a fully fixed up home or one that they could do a little bit of work themselves and make tailor-made to their desire, 80% take the second option. Only 20%, or 2 out of 10, want the fully fixed up home. It's a really good stat for you to know, from our world at least, that has really been what the metrics say. So in selling them that way, number one, you're not beholden to the market conditions when it comes to interest rates, inflation, all these things. I'm a student of our business. I read almost every night different articles and just informational pieces on what we do. And if you're not careful, just like any sort of negative news, it can overwhelm you. But there are so many things, and I found myself, all these things I can't control. I can't control what's going to happen with the Fed and what's going to happen with inflation, but I sure as hell am not going to get, excuse my language, get caught in another cycle where my whole business is predicated on me having to flip that house to a qualified buyer, and if the market changes, interest rates pricing out, or I have to reduce the price, or materials, by the way, are through the roof for rehabs, all of these factors that have nothing to do with my control are causing me, or the potential to cause me or my business to suffer. I need to figure out strategically and proactively how to get around that. And in doing so, this is where the epiphany, or really the strategy, combination of the two, Blackstone buying them and really trying to get that golden goose for a long period of time, came together. Reading these articles, reading these pieces, and it just was giving me heartburn. That I'm thinking, man, we're going to be in another big problem here. So we need to change what we're doing. By the way, we're always doing creative financing here. We're always looking for sellers who will sell to us on terms. We have a handful of those deals going right now. We have a handful of our affiliates doing deals right now in that same way. I shared on another video, one of our affiliates is cashing out a subject to deal on Monday, 3 days from today. $94,000. He made 15 grand a few years ago. Cash flow the whole time. The buyer's cashing them out. They're taking a check home for $94,000. And as I said in my prior video, that'd be pretty nice to put in your bank account, wouldn't it? 94 grand. It didn't cost them any money to do the deal either, by the way. It was a no cash, no credit deal. So that's our backbone. We're always doing those. But the best deals, the genuinely best real estate investment deals you can find, are when you can buy them distressed, whether it's physically with the condition of the home or financially, someone who's upside down or behind in payments, and you can buy that for cash and sell it on terms. You cut your capital gain in half from short to long term. You get the benefits of cash flow, depreciation. I mean, there are so many benefits in owning the real estate for a period of time, but most importantly, you can weather the storm that's beyond your control if you implement a strategy similar to this. You don't have to worry about rates going up. And let me just share 1 or 2 more tidbits and I'll tie this down, but very passionate about this because I don't want you to get caught either in the middle of a flip or in the middle of a cycle, and all these things that have nothing to do with your control take you down. It took me down. It affected my life, changed my life forever, by the way. My life and certainly the life of my family and a lot of people that were involved in our company. Don't ever want that to be the case again for us or for you. So if you can find a way to implement this strategy, you will be well served and hopefully can avoid the storm and how to weather the storm as we are kind of entering that cycle here. So having said all that, it's a strategy we're using and I want you to use it too. There's one other tidbit I just remembered I want to share. We do have an incremental stair step on how we sell the property from a price standpoint. So very simply put, we're not going to sell the property to a buyer today at a price today that they can have in 5 years. That would be foolish on our part. Even if values go up and down, I can almost guarantee you the properties today will be worth a lot more in 5 years. So if our buyers want to buy it today, we lock them in for 12 months at a certain price and a certain monthly payment. Every year, the price and the monthly payment increase by an increment that would be relative to standard market appreciation, standard payment appreciation, if you will. It'll be different in every market, but we have a different price every year of the 5-year term. So we're not going to miss out on appreciation or additional equity, and our cash flow is going to increase $1,200 every single year in that little tidbit. So that's also a little good nugget for you. So anyway, that's it, guys. It's a strategy that we're going to teach or teaching inside at the end of the day to our affiliates, the people that we're training, and it's something that I felt important enough to share with the general public as well. So if you have questions on this, you want to learn more, there's opportunities to contact us in the links, but more than anything, I hope that you got the gist of what I'm saying, and I hope there were some takeaways that will help you avoid the pain of losing frankly, your business, your deals going upside down. Hopefully this will help you avoid some of those hardships, learn from my lessons and my mistakes. And so anyway, I will see you again very soon, and I hope you got some good stuff from this video. Thank you.